All right, so another report out of the Canadian economy for the Bank of Canada to weigh, another stronger than expected report. What are they going to do with this?
I think there's two things that happened today in the report. It was stronger than expected, A, and B, the flash estimate for the coming month is also positive and strong. So what does that mean? That means that the pressure to dial up for the Bank of Canada to start hiking again is pretty much getting into the red zone here. So the hikes are highly probable at this stage, and that GDP report is very notable. We were basically in a cycle where we were going from bad anecdotes on the economy, bad data on the economy, to good data, and I kept joking that every week it would flip-flop, and we were kind of like, are they hiking again? Are they done? Are they hiking again? Are they done? And then now it seems that the are they hiking again camp has become more predominant, and we've seen the data kind of trend more positively. This GDP print's a big deal today.
Now, you dial back a year, all the aggressive rate hikes that we've had, the thinking was it would take a toll on the labor market, it would slow the economy, right, and therefore you bring inflation down. What is going on? When you look into this report and the details of this report, what is going on that we haven't seen this weakening that perhaps was anticipated?
I think, A, it takes time for this to go through. Last year was the year of hikes. This year is the year of seeing it work through the economy. It takes time. It's not... It wouldn't be a surprise to the past for the Bank of Canada to hike, pause, hike again, and then cut soon after. We've seen this before. It may happen again now. We didn't have interest rates further out the curve move much today on that report, because a lot of it is a near-term dynamic, and I think that investors and the market as a whole remains confident that this will slow the economy down, and it's just. It's the uncertainty of the near-term path, and if they have to hike another 50 basis points to get that slowdown in motion, then I guess they do it. But it's going to end up slowing us down regardless. So, not so much of a big. The GDP report matters more near-term than it does longer-term.
Okay, that's interesting. Let's dial back several days to the inflation report. I mean, sort of hand in hand right now. And is this a case of the last mile will be the hardest mile? You get inflation at a very elevated level. You start raising rates. Boom, 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 boom. The headline comes down, right, and then the word sticky starts showing up more often.
Right. I think in general we always forget about the resilience of people. People want to grow. They want to improve their life. They want to maintain their standard of living. And I think that everyone is doing everything they can to keep it going. And I think that's exactly what we're seeing right now. And eventually we can't keep it going forever. So eventually the slowing will come. But I think just taking that CPI together with the GDP, that's why the red zone for risk of hikes is we're strongly reading on the red, i.e. close to 10 out of 10 on the hiking pressure.
So we're in the red zone, only a week away from a rate announcement. Would they move as quickly as next Wednesday?
Absolutely. I think they have the GDP report behind us, the CPI report's behind us. They're going to have lots of time to process that. Absolutely, it's totally on the table.
Totally on the table for next week. You talked about the fact that you might get, you threw 50 out there. Because I was thinking, okay, if we get another hike out of them, you get a 25, maybe then they're done and they go back on pause. You said it could be as much as 50 before this rate hiking cycle is over.
Maybe another 250. No, I'm just kidding.
No, we're going to have to edit that one out. Some things are serious.
Yes, I'm kidding. On the 50 beeps is, I think generally speaking, we find that 25 beeps isn't that much of a notable increment. And so I think when they make a decision to hike again, 50 basis points feels more notable to us. That'll have taken us to 5%. So that's 50 beeps, 10% of 5%. It's in the context of the whole hiking cycle. It's not tremendous. But yes, we would generally think of if they hike again that they do to at least 225 beeps.
All right, so you're talking about the fact that after that, you can see a fairly quick reversal, and that is not uncommon going through cycles like this. What does the Bank of Canada, so say we have a scenario, we don't know this is the way it's going to play out, but we have a scenario where you get two more rate hikes at, cumulative 50 basis points, and then they're in a position where they need to start cutting. What do they need to see to start that cutting cycle?
What do they need to see this? Really what they need to see is GDP slowing or contracting, and we need to see inflation under control. So we need to see inflation getting to below 3%, and we need to see the GDP trending lower. That's what we need to see. We basically need the two of them working together or if inflation was above 3%, but we saw a substantial contraction in GDP, then that would give them confidence that inflation is going to come down as well, and the economy is already moving down, and that would give them confidence as well. And what I've said on this show before is we're going into restrictive territory. This is not perceived by the market, and it's not perceived by the central banks to be the new norm in rates. This is perceived to be restrictive territory to cool this inflation cycle that we're in and bring us back to. And then they would be cutting and get back to a neutral state. That's the ideal scenario here. The ideal scenario is we hike, we slow the economy down, inflation comes under control, GDP growth is stable. They cut back to say 2.5%. They cut back to 2% worth, and we end up in a steady neutral state. That's the ideal. A lot of times we overshoot on that. And who knows if we can continue moving a lot higher, and you know, it's potentially going even to 6% is a possibility. We don't think that's a high probability right now. It's still a possibility. That would just be
inflation just will
not. It will not relent. I think we have to entertain that possibility. That's entering conversations that we have. That talk of 6%, more so in the U.S. than it is in Canada, but it's still a conversation. So the interest rates can swing a lot. We've swung a lot off the lower bound, and so it's tricky right now. It's a really hard market to have high degree of confidence of where we are in the next 6 months.